So now we want to move on to talk about stock. We say that stock is an instrument that signifies an ownership position in the corporate and represents a claim on its proportional share in the corporate's assets and liability, as well as profits. So now when we are talking about bonds, I would like you guys to think about the balance sheet you learned in accounting classes. So then, for example, if we look at the balance sheets of a firm, we can classify it into the balance sheet that is talking about the asset value, the liability value, and the equity value. So then when we are talking about stock, the stock is about the value in this part, that is about the equity, that is the asset minus the liability. So when you hold a share of a company, you not only hold a share of its asset, but it also holds a share of its liability. The net earning of a firm that you have is a share of the asset minus liability. Finally, the return for holding stocks include the value changes of the stock and the dividends. And the dividends are a share of profit people receive by a stockholder, and there are two types of dividends. One is cash dividends, and the other is the stock dividends. When the firm pays you the dividends, if it pays the stock dividends, in fact, it does not affect your holding of the value of the firms because, for example, that if the value of the firms equals $1,000 and then there used to be only 100 shares, so then each share value will be $10. Now somehow the company issued dividends and it pays 900 shares, and then so the share becomes 1,000 shares. Then the share value you are going to hold for each will be $1. But then under the first case, given that you hold one share out of the 100 shares, so the total asset value you hold from the firm will be $10. But then after it issues 900 stock dividends, then the total number of the share becomes 1,000. When you hold one share of it, you are going to get 10 shares of it because the 100 share of the stock becomes 1,000 shares of stock. So if you hold one, that's 1% of the value of the firm. After they issue the stock dividends, you still hold 1% value of the firm. So then in here, the total value of the firm that you hold remain as $10. Okay, that is the interesting part of the stock dividends. When the firm pays you the stock dividends, in fact, it doesn't affect the total value of the percentage that you hold for the company's total value. How about for the cash dividends? When the company has the value of $1,000, then after it pays the cash dividends, for example, for $100, then there will be a $900 value of the firm that we kept, which is it only have $900 left. In that case, if you hold one share of it, the total value of each share that you hold used to be $10. Now, after the cash dividends, the stock value that you hold now becomes $9 plus the $1 cash that you hold. So again, that it will not change the total value that you own at the time that the dividends is paid. Finally, about stock, I want to introduce a term that is called IPO, which is called initial public offering. The initial public offering tells us that when the stock can be listed at the stock exchange, then it will increase the liquidity of the firm. Because before the stock is listed in the stock exchange, when you want to sell the stock, you need to find someone who is interested in buying your stock privately. You probably need to make calls. You probably need to look for someone who is interested in the stock that you are holding. However, once the stock is listed in the stock exchange, then you can go just sell the stock in the stock exchange if you want to get a cash back for the wealth that you allocated to that particular stock. Then you don't even need to know who is buying the stock. So then the good thing about the initial public offering is that it will be able to increase the liquidity of holding and assets. And then the initial public offering, it means that listed the stock in the stock exchange, and that is called the secondary market. And then the example of the secondary market can be the stock exchange or the over-the-counter, which is another form of the exchange. The abbreviation for the over-the-counter is called OTC. In US, Dow Jones is the stock exchange, but Nasdaq is OTC. And in Taiwan, the stock exchange is the stock exchange, and the OTC will be called the 柜台买卖中心. So then they have a different institute that handle the stock, and the way they trade it may be different. So that is the basic concept I would like to talk about related to stock.